What's the best time frame to trade? 4 hour? Daily? 1 minute? The real answer, it doesn't matter. Any time frame can work. Seriously. Here's why. The market is fractal. Price moves the same way whether you're analyzing a weekly chart or zoomed into a 5-minute one. So if the time frame isn't the key, what really drives success? It all comes down to core concepts: market structure, imbalances, and supply and demand. And here's where it gets interesting. Once you master how price truly moves, you can trade any chart, any pair, any session. In this video, I'll show you exactly why timeframes don't control your results. And at the end, I'll share my top 3 entry models, the same setups that help boost win rates, reduce losses, and create consistency. Let's dive in. Because in trading, it's not about the chart you pick. It's about understanding the universal principles that move the market. The examples I'm about to share will make that crystal clear. Let's start with the weekly chart of GBP/USD. Here's what we see. The market has broken structure and created a new higher high. There's an imbalance, a price gap that the market often wants to revisit. Just below that imbalance, we can spot a clean demand zone, formed by the last candle before the strong upward move. So, what does this mean for us? If price pulls back into this zone, it could offer a strong buying opportunity. Where should we aim for profit? The swing high. Why? Because we're in an uptrend, and price often seeks to clear out previous highs. This setup offers about a 3.45R trade. That means risking $1,000 could return $3,450. Yes, this is on the weekly chart, so it may take some time to unfold. But here's the real takeaway. This same pattern repeats on every time frame. Let's look at the daily chart of the US dollar index. And guess what? It's the same story as before. Price broke higher, leaving a small gap behind. That's called an imbalance. Just below that gap, there's a demand zone. That's the area where buyers are likely waiting. The plan is simple. Buy from that demand zone, put the stop just under the low, and aim for the next high. This trade offers about 3.25R. If you risk $1,000, you could make around $3,250. And this one plays out nicely. Price touches the zone and then shoots up. Same idea, different asset, different time frame. Now let's move to the 4-hour chart on AUD/USD. And yes, the pattern shows up again. Price makes a higher high, leaves a gap, and creates a demand zone just below it. Same setup. Buy from demand. Aim for the swing high. But this time, it's faster. The move finishes in just a few days and gives a 6.5R return. That's $6,500 for every $1,000 risked. This is the kind of move swing traders love. Quick and rewarding. All right, let's go micro. We're now on the 5-minute chart. Do the rules still apply? Absolutely. Structure shifts, bullish imbalance appears. Demand zone lies just below that imbalance. You buy from demand. Stop goes under the low and target the recent high, just like we did on every other time frame. See the pattern yet? It's all the same. The only thing that changes is how fast the trade plays out. Okay, now for a bit of fun. Let's jump down to the 30-second chart. Yes, I said 30 seconds. Now listen, I do not recommend trading this time frame. It's chaotic. It moves like lightning. But watch what happens. Higher highs and bullish structure. Imbalance shows up, demand zone sits just underneath the imbalance. Same entry, same target, same logic. This setup gives you around 2.85R. Not amazing, but it proves the point. The concept stays the same. So what have we learned? The market is fractal. And if you master price action, structure, imbalances, and demand zones, you can trade on any time frame. Weekly, daily, 4 hours, 5 minutes, even the 30-second. Though I hope you don't. It's not about the chart. It's about the concepts. So now you've learned how to take a trade. But what you probably haven't learned yet is the entry model. This is what helps us spot fake demand and supply zones. And more importantly, it helps us reduce risk. Here's the real game changer. There are 3 mechanical entry models that can completely transform your trading. Once you start using them, you'll not only become more profitable, you'll also be able to filter out the fake zones with confidence. Why? Because these entry models don't appear in fake zones. They only form at the real, high-probability zones, where the smart money actually steps in. Before we dive into the entry model, let's first understand a key question. How many types of break of structure are there? There are 3 main types. Guys, 1. The clean impulse, where price moves in one strong direction and breaks structure directly. 2. The inducement break, where price first leaves behind a leg that acts as inducement and then breaks structure. 3. The range breaks, where price consolidates, creating something like a trendline liquidity zone, and then breaks out. These are the 3 most common breaks of structure patterns we see in the market. Now here's the key. Our entry model is built around these break structures, and it's mechanical, meaning it can be tested, repeated, and refined. Don't just take my word for it, backtest it. See the results for yourself. And if it makes sense to you, come back, subscribe, like, and keep learning with us. That's all for now. Let's keep growing together. Here we can see a bullish trend in motion. After a pullback, price makes a clean break of structure. No inducement, no trendline liquidity, just a straight impulse. Then comes another pullback. But this time, it starts building liquidity during the retracement. Once enough liquidity is built up, price sweeps it all, and then shoots up again, creating another break of structure. Now the real question is, how do we enter a setup like this on a real chart? Let's break it down step by step. Let's do it. Here you're looking at the Euro to US dollar M15 chart. After a pullback, we get a clean break of structure. No inducement, just one unmitigated demand zone sitting below an imbalance. Now pay attention. As price pulls back, we don't take an entry immediately. We wait for liquidity to build and get swept within the pullback. You'll see the price starting to move down again after a large candle. But notice, it hasn't swept any liquidity yet. Then we get another pullback, and this time a candle sweeps the liquidity. It touches the highest demand zone and closes right around that area. That's our signal. Liquidity has been taken. From here, we shift to the M1 chart to confirm. On the M1, you want to look for a change of character, CHoCH. This is your main confirmation. Right here, we get a fractal high break, signaling that momentum is shifting. Once the change of character is confirmed, we wait for a small M1 pullback, and then that's our entry. Remember, this setup already swept liquidity on M15, which makes it a high probability reversal point. So now we enter on M1. Our stop loss goes below the causal low on the M15 chart, and our target is set to the previous high on M15. Step by step, price moves in our favor. It breaks structure again and hits our target. A clean, mechanical, high-probability trade, executed with precision. And with that, let's move on to the next topic. If you're serious about trading with smart money concepts, then here's something you don't want to miss. Having the right mindset is key, but having the right platform makes a huge difference too. That's why I've partnered with SimpleFX, a broker built to make trading easy, even for beginners. There's no minimum deposit. You can start with just $1. It works seamlessly on both your phone and computer, and it has TradingView charts built right in, so you can analyze the market without needing extra tools. You can trade Forex, crypto, stocks, and more, all from one platform. And if you're new, no worries. They also offer a free demo account so you can practice without risking any real money. Here's the best part. When you sign up through my link and deposit $100 or more, you'll get a $40 bonus to kickstart your account. Thanks to SimpleFX for supporting this video. The link is below. Feel free to check it out and start your trading journey the smart way. Let's talk about the second entry model. First, you'll notice a strong push upward, a powerful move that starts it all. Then, the market leaves behind an inducement, and shortly after, we get a break of structure to the upside. That move confirms intent, but the story doesn't end there. In that very leg, we also have liquidity sitting below, acting as a second layer of inducement. And because that liquidity exists, price pulls back once more. Then comes the key moment. It sweeps the liquidity, and without wasting any time, rockets back up with momentum. This move is clean, fast, and precise, exactly what we look for in a high-probability setup. Now let's jump into a real chart and break down how to actually take the entry. Okay guys, let's take a look at the GBP/USD M15 chart. Before taking any trade, the first thing we need to check is the market bullish or bearish? Here, we clearly see a bullish break of structure, followed by a strong bullish impulse. So in this case, we're looking for a demand zone to trade from. Right here, we've got a clean demand zone sitting with imbalance, and just above it, we've got liquidity in the form of a leg inducement. We'll mark that leg inducement. That's our FAR liquidity zone. Now watch this. The market pulls back, respects the demand zone, and starts pushing upward. That pullback also grabs liquidity from the leg inducement zone. Notice the large wick that touches the demand zone. That's key. This wick tells us there's strong buying pressure kicking in from this level. So what do we look for before entering? First, liquidity. We have it. Second, leg inducement. That's been swept. Third, it touched a high-quality demand zone with imbalance. That gives us a high-probability setup. Now let's drop down to the M1 chart to find our entry. On the 1 minute, you can clearly see a change of character. CHoCH right where that large wick formed on M15. That wick itself is our signal. It shows liquidity was taken. And now price is shifting direction. So here's the important part. Since liquidity has been swept in M15, we don't wait for another pullback on M1. We enter immediately after the CHoCH. placing our stop loss just below the wick. Our target? The previous M15 high. Look closely. Our stop loss stays safely inside the M15 demand zone, which means lower risk. And from here, we expect a strong impulse upward. As you can see, price explodes from the entry, hits the target, and moves aggressively, all without waiting for any extra confirmation. So, let's quickly recap what you need to check. Is the trend bullish or bearish? Is there a leg inducement or not? Does the POI, point of interest, have imbalance? Is it a high-quality demand zone? Has the lower time frame shifted? Do we see a CHoCH? Once all of these align, you enter. Simple as that. Alright, let's move on to the next topic. This is entry model 3, and when you see it, you'll know exactly what to do. Price is in a bullish run. It pulls back, then it starts ranging. Suddenly, it breaks the previous high. But here's the twist. During that move up, a clean trendline liquidity forms. Smart money loves that. So price pulls back, hunts that liquidity, and sweeps it clean. Right after that sweep, boom, we get a clear change of character. That's our green light. That's when this entry model comes alive. It's an advanced setup, but when you combine it with the first two models I showed you, it's a weapon. Alright, enough theory. Let's pull up a real chart and break it down step by step. You're looking at the real euro to US dollar 15-minute chart. First, we get a pullback. Then, price moves in a tight range. Suddenly, boom, break of structure. And you already know the rule. When BOS happens, we expect a pullback. Then, an impulse continuation. Simple market structure logic. Next, we hunt for a demand zone with imbalance. Right here, clear as day, we mark it. Before that, we also note the trendline liquidity sitting above. Now we wait. Price pulls back, touches the demand zone. Good. That's our signal to either use our entry model or treat it like a double confirmation setup. But remember, double confirmation won't show up every time. So, we check. We wait for a fractal change of character. And here it is. Pull back into the zone. Structure shifts from bearish to bullish. From there, we draw our fresh M15 demand zone. Buying bias confirmed. Once price taps that demand zone again, which it just did, we drop to the 1-minute chart. On M1, we want a bullish structure flip. Got it. Now wait for another pullback. We pull out the fib, mark 50%, set the buy limit. Stop loss goes just under the recent low. Leave a little breathing room. Price tags our entry perfectly. Target, the M15 high. Price rips up, smashes the target. Just 3 things to master. 1. Structure, bullish or bearish. 2. With inducement, without inducement, or range impulse. 3. POI quality. Does the zone scream high probability? Once demand is tapped, drop to the lower time frame. Execute the entry model. If you want double confirmation, wait for fractal change of character and pull back into M15 demand. Then drop down, confirm, and set your target. That's the breakdown. If this helped, hit like, smash subscribe, and tell me in the comments what topic you want next.